Hello, dear people. This is Ashok Kumar here. I am the author of The Basics of Stock Market for Beginners, and today I'll be explaining what is a put. Put is a contract which you can buy at a particular price, which is called as a premium, and at a particular strike price, which is the levels determined by the lot size. A particular company's stock has particular strike prices. The strike prices are determined by the exchange according to the volatility of the stock. Strike prices may be 22 to 25 or whatever the amount may be. If the particular stock is going upwards, then there will be more calls. If the market is going downwards, there will be more puts. If the spot price keeps increasing, the put strike prices will reduce and the call strike prices will increase. If the stock keeps decreasing in value, then the puts will be more and the calls keep on reducing in the number of strike prices available to trade. Don't forget to buy my book, The Basics of Stock Market for Beginners, in the link below. What is a put? A put goes up when the stock goes down. We can say that it is reversely proportional. As it is very near to in the money, or as it is in the money, the delta will be very near to 1. The delta's value will be between 0 and 1. As it is very near to 1 in delta, the futures price increases by 1, the put decreases by 1 as it is in the money, deep in the money. So that will be the proportionality. This is the reverse proportionality depending on the delta. However, as it is going at the money or out of the money, there will be a huge time decay. As it nears to the expiry, the value of put decreases too much when it is out of the money or at the money on the day of expiry. Just to give you a recap, put value goes up when the future price goes down. So put is reversely proportional to futures price move. If you want to know what is futures and options, you can check this video out. And if you want to know what are stock markets, how does it actually function, you can check this video out.